Welcome to our latest video on the different types of crypto trading platforms. In this video, we will be diving into the various types of platforms available to traders, including spot trading, margin trading, futures trading, and options trading. First, let's start with spot trading. This is the most basic type of crypto trading, where you buy and sell digital assets at their current market price. It is the most straightforward way to trade crypto and is the most commonly used method among retail traders. Spot trading, also known as spot market trading, is the most basic and commonly used method of trading cryptocurrencies. It involves buying and selling digital assets at their current market price, with a trade being settled immediately. This means that when you buy a digital asset through spot trading, you own it and can hold it for as long as you want. Spot trading can be done on a variety of platforms, including centralized exchanges, decentralized exchanges, and peer-to-peer marketplaces. Centralized exchanges, such as Binance and Coinbase, offer a wide range of cryptocurrencies and are typically easy to use, but they may require you to go through a KYC, know your customer, process and may also charge higher fees. On the other hand, decentralized exchanges, such as Uniswap and SushiSwap, offer more privacy and lower fees but may have a smaller selection of cryptocurrencies and a slightly more complex user interface. Peer-to-peer marketplaces, such as local bitcoins, allow you to trade directly with other individuals, but they may not be as secure as centralized or decentralized exchanges. When spot trading, it's important to pay attention to the bid-ask spread, which is the difference between the highest price a buyer is willing to pay for an asset and the lowest price a seller is willing to accept. A tighter spread generally indicates a more liquid market and lower trading costs. Additionally, you should also be aware of the trading fees, deposit and withdrawal limits, and the security measures of the platform you are using. In summary, spot trading is a simple and flexible way to buy and sell digital assets. But it's important to be aware of the different platforms and their features, fees, and security measures before diving in. Next, let's talk about margin trading. This type of trading allows traders to borrow funds from a broker to increase their buying power. This can be a great way to amplify potential gains, but it also increases the risk of potential losses. It is important to note that margin trading is only for experienced traders and should not be attempted by beginners. Margin trading, also known as leverage trading, is a type of trading that allows traders to borrow funds from a broker or exchange to increase their buying power. This means that traders can enter larger positions than they would be able to with just their own funds. For example, if a trader has $1,000 in their account and wants to enter a $5,000 position, they can use margin trading to borrow $4,000 from the broker, bringing their total buying power to $5,000. This allows the trader to potentially make larger profits, but it also increases the risk of potential losses. Margin trading can be done on a variety of platforms, including centralized exchanges, such as BitMEX and Binance, and decentralized finance, DeFi, protocols, such as Aave and Compound. The terms and conditions of margin trading vary depending on the platform, but it typically requires traders to maintain a certain level of collateral, known as a margin requirement, to cover the potential losses. Margin trading is generally considered to be more advanced and risky than spot trading, and it's not suitable for beginners. Traders should be aware of the potential risks and be prepared to lose more than their initial deposit. Additionally, they should also be familiar with the concepts of liquidation and margin calls, which occur when the value of the collateral falls below a certain threshold. In summary, margin trading allows traders to enter larger positions than they would be able to with just their own funds, but it also increases the risk of potential losses. It's important for traders to have a good understanding of the risks and be prepared to lose more than their initial deposit. Additionally, it's important to be familiar with the platform's terms and conditions and to always maintain a healthy level of collateral. Moving on to futures trading. Futures trading is a type of trading in which a trader agrees to buy or sell an asset at a future date at a predetermined price. This type of trading is typically used by traders to speculate on the future price of an asset or to hedge against potential price fluctuations. Futures contracts are standardized agreements between two parties to buy or sell an asset at a specific price on a specific date in the future. They are traded on specialized exchanges, such as the Chicago Mercantile Exchange, CME, and the Intercontinental Exchange, ICE, and are commonly used for commodities, such as gold and oil, as well as for financial instruments, such as stock indices and government bonds. Futures trading for crypto has been gaining popularity over the past few years, with more and more exchanges, such as Binance and OKEx, offering futures trading. These futures contracts are similar to traditional futures contracts, but the underlying asset is a cryptocurrency, such as Bitcoin or Ethereum. When trading futures, traders can choose to go long, which means they believe the price of the asset will increase and want to profit from that. Or short, which means they believe the price will decrease and want to profit from that. Traders can also use leverage, meaning they can control a large position with a small amount of capital. Futures trading can be a useful tool for traders looking to hedge their positions or speculate on the future price of an asset, but it also carries a high degree of risk. It's important for traders to have a good understanding of the risks and be prepared to lose more than their initial deposit. Additionally, traders should also be familiar with the platform's terms and conditions and the concept of margin calls, which occur when the value of the collateral falls below a certain threshold. In summary, futures trading is a type of trading that allows traders to speculate on the future price of an asset or to hedge against potential price fluctuations. It's important for traders to have a good understanding of the risks and be prepared to lose more than their initial deposit. Additionally, traders should also be familiar with the platform's terms and conditions and the concept of margin calls. Lastly, let's discuss options trading. This type of trading allows traders to speculate on the price of an asset without actually having to buy or sell it. Traders can buy or sell options contracts, which give them the right, but not the obligation, to buy or sell an asset at a specific price at a later date. There are two main types of options contracts: call options and put options. A call option gives the holder the right to buy an asset at a specific price, known as the strike price, on or before a specific date, known as the expiration date. A put option gives the holder the right to sell an asset at a specific price on or before a specific date. Options contracts can be traded on various exchanges, both centralized and decentralized, such as CME, CBOE, and decentralized platforms like DEDX, and are typically used as a form of risk management or as a way to speculate on the future price of an asset. For example, a trader who believes the price of an asset will increase in the future may buy a call option, while a trader who believes the price will decrease may buy a put option. If the price of the asset does indeed increase, the trader who bought the call option can exercise their right to buy the asset at the strike price, potentially making a profit. Similarly, if the price of the asset decreases, the trader who bought the put option can exercise their right to sell the asset at the strike price, also potentially making a profit. Options trading can be complex and requires a good understanding of the underlying asset and market conditions, as well as the options contract terms and conditions. Additionally, options trading also carries a high degree of risk, and traders should be prepared to lose more than their initial investment. In summary, options trading is a type of trading that allows traders to speculate on the price of an asset without actually having to buy or sell it. It can be used as a form of risk management or as a way to speculate on the future price of an asset. But it requires a good understanding of the underlying asset and market conditions and carries a high degree of risk. Traders should be prepared to lose more than their initial investment. In conclusion, understanding the different types of crypto trading platforms can be crucial in finding the right fit for your trading strategy. Each platform has its own unique features and risks, and it's important to carefully consider which one best aligns with your goals and risk tolerance. Thanks for watching.